Ever have that moment where you look at your bank account and just wonder, am I totally messing this up? Or is everyone else just as lost as I am? Well, let's get into it.
We're about to look at some pretty wild statistics about how the average person really handles their money. Because seeing what normal actually is, that's the first step to deciding if that's a club you even want to be a part of.
But here's the big question we're going to tackle. What if being financially average isn't a good thing? What if it's actually a huge red flag? As you're about to see, being normal might be the one thing that's holding you back.
All right, let's kick things off with what I call the everyday money traps. These are the active mistakes, the things that look so easy and convenient on the surface, but have some seriously nasty hidden costs. First up, car loans. Get this. More than a quarter of all car trade-ins are underwater. That just means that people owe more on the car than it's actually worth when they go to trade it in. And we're not talking about a couple $100 here. The average amount that people are upside down is nearly $7,000. Just think about that. You're walking into a dealership and basically paying thousands of dollars just for the privilege of getting rid of your old car. It's insane.
So how does this even happen? Well, it's kind of a perfect storm, right? You've got these super long, like 84-month loans that make the monthly payment look small, but they keep you in debt forever. Then you throw in the crazy inflated car prices we've all seen, and yeah, it is a recipe for a financial disaster.
Okay, let's move on to the next modern money trap. Buy now, pay later. It feels so harmless, you know? Just split it into 4 easy payments. But the average person using these services is carrying a balance of over $700. It's the kind of debt that just quietly creeps up on you.
And when you look at the reality of it, it's not pretty. Almost 40% of people regret using it, and nearly a quarter have missed payments. And here's the kicker. It's super popular with high-income earners. People making 6 figures are putting everyday stuff on a payment plan. It just goes to show you, a bigger paycheck doesn't automatically mean you're making smarter money moves.
And all these little debt traps, they lead to this really fragile situation. I mean, check this out. A shocking 60% of Americans cannot cover a surprise $1,000 expense. One bad car repair, one unexpected trip to the doctor, and more than half the country could be thrown into a financial tailspin. You know, it's not always about making bad decisions, though. Sometimes the biggest trap is doing nothing at all. This section is all about the cost of inaction. It's where wealth just quietly goes to die. Get ready for this number. A mind-blowing 82% of people are not using a high-yield savings account. There is literally over $18 trillion just sitting in regular bank accounts getting absolutely demolished by inflation. Let me put that in perspective for you. Let's say you have $5,000 in a regular savings account. After a year, you might make, $20? Barely enough for lunch. But that same $5,000 in a high-yield account, that could be $175. It is literally free money that people are just leaving on the table.
And if you think that's bad, this next one is even more painful. So you do the right thing, you open a retirement account like an IRA, but then almost 30% of people just leave the money sitting there as cash. They don't actually invest it.
There was a fantastic line in the source material for this, and it just hits the nail on the head. Leaving your retirement money in cash is like buying a brand new sports car and then using it as a planter for your garden. You had this high-performance machine, and you're just using it as a decoration. You miss the entire point and lose out on years, even decades of potential growth.
Okay, so we've established that being normal is actually pretty scary. So what's the alternative? How do you actually get ahead and beat the average? Let's talk about the blueprint.
The first principle is honestly just patience. Yeah, the stock market can feel like a roller coaster. We all see the scary headlines. But historically, it has been an incredible wealth-building machine, doubling in value on average about every 10 years for people who just stay in it. But, and this is a big but,
There is a price of admission to get those long-term returns, and that price is volatility. Look, in almost 40% of years, the market drops by at least 10%. That's just part of the game. The secret isn't avoiding the dips. It's not panicking and selling during the dips. That is how you capture the real long-term gain.
And if you can do that consistently over time, this is where it can lead. To be in the top 10% of Americans, you need a net worth of just over $1 million. And I know that number sounds huge, but it's really more about discipline than it is about having a massive income. It's about what you do with your money, not just how much you make.
Which brings us to our final and honestly probably the most important point of this whole thing. Let's talk about the single most powerful tool you have for building wealth, especially when you're just starting out. And I'm telling you, the answer is probably going to surprise you.
So let me just ask you this. To get ahead faster, what do you think matters more? Being a fantastic saver who puts away a ton of cash, or being a genius investor who gets incredible returns?
Okay, check out this little race to the first $100,000. You've got person A. They're a great saver, putting away 10% of their income, but they get a tiny 1% return. Then there's person B. They only save half as much, 5%, but they're an investment wizard, pulling in 10% returns. So, who gets to 100 grand first? It's person A. The high saver gets there almost 3 years faster.
And this is the big takeaway right here. When you are starting out, your savings rate is so much more powerful than your investment return. We all get obsessed with picking the perfect stock, but the boring old task of just saving more money, that is what really moves the needle when you're starting from scratch.
So, let's bring it all together. The path to beating the average isn't some big secret. First, you have to recognize that normal finance is a trap. Second, you got to steer clear of easy debt and build yourself a safety net. Third, put your idle money to work. And finally, and this is the big one, focus on your savings rate above everything else, because honestly, your financial future depends on it.
Look, at the end of the day, being average with your money usually means living with a lot of financial stress. And beating the average doesn't mean you have to be a genius, it just means being a little more intentional than everybody else. So the real question isn't whether you can afford to make these better choices, it's whether you can truly afford not to.